I want to explore with you today a pretty basic question, which is what would cybersecurity policy look like if we could actually measure the risk that that policy is trying to control? The work here is really joint work. It's in fact not just computer science and law. It's really economics, computer science, and law. My colleague Andrew Lowe, who's an economist at the Sloan School and a leading expert on financial market risk, we dragged him into this process because I figured we needed someone who could actually understood how to study risk, and Vinod Vaikunathan, who's one of the world leaders in the development of various kinds of cryptographic computing, and a number of others. So this talk is really an exploration of the policy implications of some early technical work that we've done, where we've shown that it actually is possible in a secure and private way to do risk measurement across a number of enterprises and learn more than we currently know, learn different things than we currently know about cyber risk. Just a quick overview of the talk. I'm going to give a brief characterization of the way I see our cybersecurity safety problem today. I'm going to give you a sketch of the general policy toolkit that we tend to be able to apply when we're trying to protect society from harm and manage risk. I'm going to focus on the role that insurance plays along with liability frameworks in this risk management process, talk a little bit about some of our early research results, and then point ahead to what we actually might be able to achieve here. So what we know in simple terms is that there are mounting losses as a result of various kinds of cyber attacks. Some of those losses are measurable, at least partially measurable, in the financial liability that they cause. Firms have to spend a lot of money to try to protect themselves against cyber attack. Firms end up paying quite a bit of money when they get caught being inadequately protective of the data that they're trying to control. But there are also a lot of unquantified losses. Whole cities have been shut down for periods of time because of the inability to do things like process tax payments, process building permits, pay traffic tickets. Hospitals have been severely impaired because of various kinds of cyber attacks. So we have really very substantial financial and social losses as a result of the vulnerabilities we have in our information systems. Oddly enough, some of the leading corporate entities that have to face this have taken this, I think, sort of bizarre, no budgetary limit approach to cybersecurity. They'll spend as much as they need to on cybersecurity. Here's the real problem. They don't know how to figure out what they do need to spend and what they don't need to spend. And a lot of this talk is going to be about trying to answer that question. I want to give you a really quick high-level view of the basic tools that we tend to have in our toolbox, in our policy toolbox, when we're trying to manage broad societal harm. I think it's clear now from certainly from the computer science community that we're not going to be able to build systems that eliminate cybersecurity risk. We're not going to be able to build perfectly secure systems, but rather what we have to do is figure out how to manage those risks to keep them down to a minimum, and importantly, how to manage those risks in an economically efficient manner. If we spend too much money trying to protect our systems, we'll ultimately lose the value of those systems. If we don't spend enough money, we have losses that spread out around society. So how have we dealt with this kind of problem in the past? The foundation, at least in the US and British legal systems for managing risk is a part of law that's called tort. And that's basically a way for an individual who feels harmed by someone else to go to a court and say, someone who was supposed to take care of me, who was supposed to exercise care for some harm to me that was foreseeable, failed to do that. And in particular, failed to meet the appropriate standards of behavior. Often in a commercial context, this gets reduced to a claim that the individual, or more likely the enterprise, failed to meet common industry practices for whatever that resulted in whatever the loss was. Sometimes we generalize beyond individual tort law. That can be fine for individual recovery of losses, but it doesn't necessarily manage society's risk very well. So we also have broad regulatory frameworks, things like the Clean Air Act, the Clean Water Act, our aviation laws, our laws about how highways are constructed, our banking regulations, all of which essentially establish rules, substantive rules, that these institutions, these entities have to follow in order to keep society safe. And the understanding is, if you follow those rules, your liability as the entity potentially incurring risk will be limited. So sometimes we go beyond this individual set of claims between one party and another and say everyone who's participating in a particular market or particular industry or particular practice has to follow a set of rules. When we do that, we have to be pretty sure that those are the right rules, that they're adequately protective but not too expensive. And that's not always easy to do. There's a whole category of risk that we manage through a kind of an interesting dance of legal liability and insurance. And this is everything from fire and auto insurance, health insurance, and insurance for all kinds of activities is a way that we were able to manage risk. And usually the way this works is that insurance companies have enough information to be able to issue policies to any given entity that says, we'll protect you against certain kinds of losses, provided you meet certain kinds of standards. And this is where the fourth component of our risk management toolkit comes in. We have whole sets of standards, best practices, knowledge sharing mechanisms that try to propagate technically developed understandings about what are good safety standards. And these range from everything from electric appliances to standards for how chemicals are supposed to be produced and handled, all the way to building codes. I'm going to tell you a quick story about, I'm going to talk a little bit about the kind of core economic idea of insurance, and then I'm going to tell you a quick story about the fire insurance situation, and then look at auto insurance, because I think they're both instructive for us here. From an economic perspective, it's important to understand the basic theory of insurance. The basic idea behind insurance is to produce what's known as consumption smoothing. What that means is that individuals want to be able to manage their utility, that is, manage their costs across a whole number of different states of the world. Most people in the US will buy health insurance because they know that there are certain points in time when they may have very, very large healthcare costs that they have to manage, and they're willing to spend a certain amount of money every month to be able to smooth out those costs. We buy home insurance or auto insurance for the same kind of reason as consumers, because even though for the most part we may not need insurance on a day-to-day basis, we don't face losses on a day-to-day basis, we may even never face losses, but we do want to make sure that in the event of a big loss, we don't get overwhelmed by it. And the economists who have studied this will tell us that provided insurance companies can determine what are called actuarially fair premiums, that is, they can figure out what their costs to cover risk is, that this is actually the most economically efficient thing to do, to have everyone covered by some kind of insurance so that we smooth out the risk across different parts of society. But again, that depends on being able to calculate the actuarially fair premiums, and in some cases, being able to require certain kinds of behaviors. A really early example of this, insurance has been around for millennia, but in one way or the other, but I think a wonderfully compelling modern example comes from Ben Franklin, who seems to be responsible for almost everything good in the United States, somehow or another, at least in its early days. Ben Franklin, as you know, lived in Philadelphia. All the houses in Philadelphia were made out of wood, and they were heated with either wood or coal fire stoves. And not surprisingly, a lot of them caught fire. And when houses caught fire, not only did they do damage to themselves, but they also the fire tended to spread. So there was an imperative to figure out what to do about this, because Philadelphia was constantly burning down. Ben Franklin, being a creative guy, created this institution called the Philadelphia Contributorship. It was an early insurance company, actually a mutual company, which was just a collection of individuals who lived in Philadelphia and agreed to pool their resources such that if anyone, well, I'm sorry, I skipped a step in the story. The first step of the story is that Ben Franklin helped create the first volunteer fire departments. And that helped manage the fire risk, but the problem was that some people were more careful on their individual behalf about managing fire risk than others. So what they did was to create this insurance company. They all put money into it. This clever little four hands symbol was an indication that was put on homes that the homeowner was a member of the insurance company. Whenever there were losses, whenever there was a fire, of course, the volunteer fire department would go try to put the fire out. If they didn't succeed at putting it out, or there were some losses, the insurance company would cover the losses suffered by the homeowner, but only on certain conditions. They had to have certain architectural features built into their house to reduce the likelihood of the fire risk. And certain policyholders actually had to pay higher rates, like breweries, because they were more likely to suffer losses here. The volunteer fire companies would fight any fire because it was in everyone's interest, but they tended to put a little more effort into and give priority to the policyholders, to the members of the Philadelphia Contributorship, in some part because the firefighters themselves were mostly member of that contributorship, and they wanted to make sure that they were encouraging others to join and contribute to this way of reducing loss. And that led to a lot of what we know as the current insurance framework in the US. The second example I want to point you to is the way that we've evolved auto safety regulations. And there's a kind of an interesting, delicate dance that goes on between government safety regulators who do set substantive standards about what's required of cars, for example, that they can meet certain crash standards, that they have seatbelts, that they have airbags, et cetera. But along with those government regulators, the insurance industry has actually put a lot of resources and has developed an even more rigorous set of safety standards because they want to make sure that their policyholders are safe, and not coincidentally that they limit the amount of premiums they have to pay out. The auto manufacturers, by and large, have to follow those standards, because if they don't, what will happen is their cars become too expensive to insure. And this is really, so the kind of key dynamic here. Over the last 70 years, there's been a pretty substantial decline in automobile fatalities, both as a proportion of population and vehicle miles driven. And that's happened because of this evolving dynamic of continually setting new standards for safety and continually doing research on what are the most important safety features to put in place. Obviously, if you're prepared to spend hundreds of thousands of dollars on a car, you could probably make it a lot safer. That's not economically efficient. That would eliminate the ability for most people to own cars. But what insurance companies have actually done through this mechanism is they've, over time, analyzed which are the more and less safe cars, which are the mechanisms in cars or the designs in cars that cause more crashes or avoid more crashes, that cause more fatalities or avoid more fatalities. And ultimately what they've done is they've looked at how much money they're paying out in insurance claims. And the result of this is that they are able to tune their premium levels to different cars and to different requirements for safety features that have to be built in order to get certain kind of insurance. This stands in marked contrast to the situation that we have in cybersecurity. There have been, as many of you know, I'm sure, a number of different large cyber breach investigations that result in some cases, quite substantial damages recovered. But what I want to show you here is that the way that damages are assessed, that is the way that liability is assigned, the way that externalities are managed, is, I would say, far from rational and far from efficient. Here's just one example. Recently, the UK Information Commissioner, their Data Protection Authority, which is an excellent data protection authority, I think one of the best and most sophisticated in the world, found that there was a major data breach at British Airways. It resulted in the loss of data from almost 500,000 data subjects. Originally, they assessed a penalty of 183 million pounds. That was a lot of money. In the end, British Airways only ended up paying 20 million pounds because they consistently negotiated down and down and down the amount. The whole basis for calculation of the penalty was based on a really entirely non-validated formula about how to assess the severity and the context and the particular losses in a given data breach. But what the key point you should take away from this is that these penalties appear to be far from connected to any kind of ability to actually tie penalties to incentives to reduce losses in the future in any kind of efficient way. So what would we need to do to change that? In kind of simple terms, what we would need to do to get to what the economist John Gruber, who I cited earlier, describes as actuarially fair insurance prices, is that you have to know something about where the losses come from, that is what caused the loss, and which kinds of breaches, which kinds of failures of cybersecurity defense mechanisms result in which kinds of losses. If you know that, if you know the loss event frequency across different kinds of failures, and if you know the magnitude of loss, that is the dollar value of loss, then you can start to assess risk in a reasonable way, and you can start to price insurance in a reasonable way and put reasonable requirements on insurance mechanisms. The problem is we don't know how to do either one of these. We don't know how to either actually measure the loss event frequency or the loss magnitude. The result of that was that the colleagues who I mentioned at the beginning of the talk got together and decided we needed to figure out how to actually start to measure some of these loss events and harm events across a number of enterprises. And I'm not going to go into the technical detail of the platform we built, but in short order, we built a platform based on multi-party computation and homomorphic encryption techniques that enables us to work with a series of firms who could collect information internally about the data breaches that they had suffered, what controls or what cybersecurity defenses had failed, and what the magnitude of the losses were associated with each of those failures. We did this really as a proof of concept. We worked with 6 large firms, all of which have, I should say, better than average cybersecurity practices. We needed to do that for a variety of reasons. These firms represent an average revenue of almost 25 billion dollars, large number of employees, and we actually had each firm look at a total of 171 kind of standardly defined cybersecurity controls. The result of this research is published here in the Harvard Data Science Review over the summer. I want to give you an idea of the kind of findings that we were able to make, and let me stress that we don't actually claim that we have enough data yet to really make event distribution claims or loss distribution claims. But this is an example of the kind of learning that we believe we can get that we think will contribute in the long run to a much more rigorous approach to cybersecurity risk measurement. First of all, we were able to determine what you see here in the text here are the various controls, and this is one particular control framework, the CIS control framework that I said identifies 171 different cybersecurity controls. We asked firms to begin with just count for each control how many times were they responsible for certain failures, and we found that there were these top 5 controls in this study that appear to correlate with a significant number of losses. We also were able to find that the monetary losses, so this is not a measure of the number of intrusions, but the total dollar cost of the losses, were clustered in this small number of controls. And you can see here the loss distribution was really quite heavily skewed towards, again, a very small number of controls. How this data bears out, we'll have to see, but it certainly does start to give guidance to both enterprises that want to understand where to invest in certain kinds of controls and insurance companies that want to set standards about what sort of controls need to be in place. There's now a lot more data than there used to be about how to make those kinds of choices. And these are the particular controls that we found were most problematic. One of the interesting things we found is that there were many cases in which controls that were implemented were also responsible for quite a lot of failures. So that says that we need to actually look more carefully at what it means to implement a control, whether we've got these categories properly defined, whether the controls that are defined in this CIS framework, which is quite widely used, are actually even the right ones to look at. The framework, this framework of defining cyber defenses was developed by a lot of thoughtful contribution from CISOs, but in fact was never really validated as having identified the controls that actually matter. For us, the next step is to expand the number of companies that are participating in this study. As I said, we had 6 companies. We actually had 7 originally. Interestingly, though, one of those companies had a very, very large, kind of 2 orders of magnitude larger than anyone else data breach, and we realized that if we included them in the study, we would be revealing a lot of information about the internal workings of that firm. So it's, as a side note, an interesting example of some of the limitations of cryptographic computing in this case, in that revealing even aggregate computations, not surprising to this group, could be harmful. Our plan is to work with about 70 firms and to pick about 7 sectors from which to draw those firms so that we can learn about cross-sector behavior and intra-sector behavior as well. I want to wrap up here by offering you a sense of what I think could be different in the cybersecurity arena if we actually do measure risk. And I'm coming back to the original toolkit that we discussed as our kind of core ways of managing large-scale societal risk. So in the area of tort law, that is individual claims based on individual data breach incidents, I think that we would be able to both assess, certainly assess tort liability in a much more rigorous way, because today we don't really have any validated sense of what are the right industry standards for taking reasonable care in the area of cybersecurity defense. If we can start to measure the effectiveness of different controls, different configurations of systems, ability to resist against certain different kinds of attacks, the next time there's a major tort claim based on a data breach, you could actually also introduce evidence about whether the defendant had actually behaved in a rational manner or not, or whether it was avoiding costs that it in fact should have borne. Number two, the more command and control regulation and the kind of supervisory regulation that we see in the case of financial institutions, for example, we think could be much improved. In particular, a lot of the cybersecurity risk that we worry about occurs with banks and other financial institutions. They're very heavily regulated institutions. They're institutions that are used to being audited for their financial performance. They're now all audited by their regulators for their cybersecurity posture as well. But the fact is, it's not clear whether they're being audited for the right behaviors, the right internal technology deployment or administrative deployments in their cybersecurity efforts. So we think that it would be possible to actually make audit standards quite a bit more rational, and to have those audits collect data that could actually be used for industry-wide research of the sort that I described. There's no reason why when a bank regulator audits all the banks in a particular country in its jurisdiction, for example, it shouldn't be able to also analyze that data to understand more about risk metrics. But right now, they're simply not doing that because they don't know what the risk metrics are. We think this can all contribute to that. I think the role of insurance in cybersecurity risk management is quite important. Cyber insurance has been touted as a major tool in the cybersecurity regulatory toolbox, but the reality is, we think you look at it, it seems relatively ineffective at this point. Cybersecurity policies, when you evaluate them, actually have very high deductibles, very low recovery caps, and don't tend to set necessarily very efficient standards for the performance of their insured entities, of their customers. The result of that is that the insurance industry is not able to send economically efficient signal to firms, and that we are not able to move towards this most efficient posture of full insurance, simply because there's no ability to actually determine the actuarially fair price for insurance. Finally, there is a lot of effort that's expended in the cybersecurity community on developing better standards for cybersecurity practices, on sharing information about particular kinds of threats. But all that sharing doesn't tend to do the kind of analysis that we've shown is actually possible. It doesn't enable firms to actually compare their investment rates against their peers in order to figure out whether they're investing at the right level or not. It doesn't do the kind of cross enterprise analysis of risk that we're able to do. And so the result is a lot of the information sharing effort we think is not unimportant, but could be made quite a bit more valuable if we actually had better quantitative risk metrics. So what I've done here is to try to paint you a picture of the kind of policy environment we could have if we can actually do better quantitative assessment of cybersecurity risk. I'm hoping that at least one person will ask me a question about the so-called dynamic adversary. I think a lot of people in computer security have tended to dismiss the ability to do these kind of validative quantitative risk metrics on the theory that the adversaries are dynamic and can adapt much faster than anyone can develop any risk metric. What I would say is, like many things in the cyber risk dialogue, that claim could be true, or it could be completely false. But right now we have no idea. I do think if you think about what any of you may know about some of the large data breaches, you'll know that a lot of them actually are the result of a kind of a repetitive exploitation of known risks. So it's not obvious to me that that a dynamic adversary defeats the ability to actually measure risk better. Anyone who claims it does, I think, needs to show some data. And even if the adversary is dynamic, the defense mechanisms that we have, for better or for worse, are not all that dynamic. And we're going to have to figure out how to do the best with them we can. And I think this is a mechanism for doing that. So I want to end there, and we'll look forward to any questions